Hi, everyone, and welcome to the Tipper Analytics monthly update for January 2024. We're putting this presentation together for family and friends, the Real Vision community, and our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. The aim today is to provide some insight into the framework and strategy I personally use to trade my current Bitcoin position by talking through my logic and reasoning, showing the updated data and analysis tools I'm referencing, and providing real-time conclusions that I've come to. The format today is a little bit different. It'll involve me running through my updated presentation for the month first, followed by some thoughts and expert panelist opinion from Joey today. And then we'll open the floor to the questions from our live audience. So this is all being recorded live today so that we can try and make this engaging and actually address any questions or comments that people have about the content as we go. So I always welcome feedback and discussion. So follow me on X at Tipper Analytics to stay up to date or reach out if you have any of that. Before we begin with the analysis, just a quick reminder that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Okay, so to start us off, as I always do, it's useful to understand this big picture framework I'm using that guides my analysis and financial decision making. A lot of it revolves around the work of Michael Howe from Cross Border Capital and how he defines this concept of global liquidity. The reason I rely so heavily on the work of Howe and Cross Border Capital is because they meticulously gather data on all the components that make up global liquidity each month, much more comprehensively than other sources I've been able to access. So I find most alternative sources really don't address this whole picture, and that they really just talk about this bit down here, central bank money. They don't really address the rest of it. And that actually makes up a very large component of the total. So it is quite important to understand the whole picture of global liquidity when using it the way that we do here. So you've seen this chart before as well that I like to bring up each month. It's basically showing that liquidity in simple terms can be thought of as how much money there is in the system, and it's going in one direction, which is up and to the right. So it can really be represented in different ways, which is where it becomes complex. But the big picture view is that total liquidity is always going up because there's always more money or more fiat currency that's coming into the system in various forms. Governments really have no choice as the debt burden continues to grow and needs refinancing. And we'll talk a little bit more about that later, but it can only continue going up. That leads us to this chart, which, even though we've got that broader trend of liquidity always remaining increasing over time, there are predictable cycles within the creation of all this new currency that are quite consistent. So governments go through periods of slowing down the production of new liquidity and speeding it up, attempting to smooth out the booms and busts in their individual economies. And that's what this chart is showing. You can see really this sine wave goes over a long period of time, periods where they're increasing liquidity, periods where they're pulling back liquidity. And the black line underneath is what we refer to as the Global Liquidity Index, which is sort of showing the actual data beneath that. So that's quite important. We can actually zoom in on that a little bit and look at it in reality, because what we see is during those periods where money is being pulled out or liquidity is being pulled out of the system, we tend to see what's referred to here as banking crises. So we've had multiple examples of that throughout history. And when money's being pumped into the system, we see asset price booms. And that's what you can see lots of examples of here as well. That's really important to understand, because if we can pull ourselves out of the market when we're during the sort of turning point from an asset price boom and be out of that market during the banking crisis, the crash period of that cycle, it's really going to help us in terms of being able to come back in rather than just holding a fixed quantity of an asset indefinitely. So that's something we look to do. We look to find ways to take advantage of this cycle. So to see that cycle in reality, the heat map's always my favorite. What this is showing, if you look over here, is periods of green, like we went through back in 2021, where lots of liquidity was being pumped into the system, periods of red, where lots of liquidity is being extracted from the system. And you can see the transition period that I would argue we're in now, like we have here, where we move from a green regime to a red regime. And that's it's a little bit elongated at the moment, but you can see a lot of green starting to pop up in this heat map. And what's really interesting about this is all of the countries listed down the left that are being monitored, and whether they're injecting or extracting liquidity from the system. So it gives you a pretty good at a glance view of what's happening. And you can clearly see that we're moving out of that really strong red period of rapid contraction. So understanding what liquidity is like we do now, some assets are better than others at more accurately reflecting the global liquidity cycle. So even though most assets go up over time in dollar terms because there's more liquidity added into the system, that kind of makes sense. Gold and Bitcoin are two that we specifically look at because they act as monetary inflation hedges. And we'll talk a little bit more about that later, but in some detail, hopefully with Joey as well, that gold and Bitcoin in particular, they serve no real other purpose other than to protect you or hedge against monetary debasement. So that's what we see going on. And this chart here, if we look at it with gold over this longer term, is really lining up, particularly recently, where we've had the peak in gold. So that what I've highlighted there in the background, you can see the gold chart. We can see the peak of that cycle, that most recent cycle in August 2020, lined up almost exactly perfectly with the peak in the liquidity cycle, which is the colored line for going from red to green that you can see below on top of it. Same with the low down here. Historically, it has lined up as well, not necessarily as accurately as it has recently, but that is to do with the fact that we're entering really a period of unprecedented liquidity growth where we've just seen governments really injecting a lot more liquidity than they have in the past with debt really, I would argue, spiraling out of control, which is why we've seen it really line up recently. So if we zoom in a little bit on that one, looking at gold, you can see that a little bit closer over a shorter period of time, that it lined up very nicely. This is the gold price, the average of the gold price over those months. It dipped down. We saw the low that occurred at the low of the liquidity cycle. And right now, as liquidity is starting to really take off again, you can see in this last month, it's really, really pushing up quite aggressively. So too is the price of gold. So we're seeing that play out. It's a very similar story with Bitcoin, except Bitcoin is a preferred way to trade the liquidity cycle in many ways because of its volatility. Not necessarily for everyone. Some people wouldn't prefer that volatility way, but we're effectively getting a 5 times multiple on the liquidity cycle over what we see with gold, with Bitcoin as a general rule. So what we've got is, while Bitcoin remains a relatively young asset, still gaining adoption, volatility is actually a feature and not a bug when you're trading this way, because what you're seeing is the correlation, but with bursts to the upside. Looking at this chart here, which is one put together by Raoul Powell, it actually is just highlighting the correlation coefficient of the relationship between their version of global liquidity, slightly different to one we're using in Bitcoin. And it's up here nearly at 87%. So that is a very strong correlation. And in fact, what's really interesting about this is that it would be even more correlated if we didn't see massive spikes up in the price of Bitcoin that we do. So you really can think of it effectively as an exponential gold, which for those who have the tolerance for that, it's absolutely the way to play the liquidity cycle. So with that background in mind, looking at the same charts we're looking at before with gold, but this time with Bitcoin, you can see, again, this perfect correlation lining up where the low in the cycle. And this chart, just for the record, this chart is actually a logarithmic chart. So even though it looks like very similar to the gold chart, there's big moves between there and there when you make this chart logarithmic. And what we saw is that the low in that particular cycle lined up quite nicely. We saw the high was a little bit delayed. I've talked about this in the past. We did see an earlier high, but it made a slightly higher high. So it puts the Bitcoin cycle high back a bit later in that cycle. But you're still seeing high correlation, and particularly at these lows, which is what we saw here. November low in Bitcoin cycle lined up almost perfectly with the October low in the liquidity cycle. So really very strong correlation. And look at this just taking off. If we zoom in on that chart even closer, this chart is not logarithmic. So this blue line is not logarithmic, and you really see just how far it moves. It's really taken off to correspond with the uptick that we've seen in liquidity, almost 1-to-1, but with that multiplier that you get with Bitcoin on top of it. So really, so far, it's playing its role very nicely indeed. So just a word from our sponsor. This monthly insight's brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum and crypto online or in the Brisbane and Melbourne showrooms. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. So we now move from the framework, which we've established, which is why we're looking to trade Bitcoin, to the strategy, which outlines the specifics of how we'll execute the trades. And I've written that down here. Basically, we go through and identify where we are in the global liquidity cycle, which is what we were just talking about. When we build up conviction that the lower of the cycle's in, we buy Bitcoin. Very simple strategy here. We use a signal to do that. When we have conviction that the high of the liquidity cycle is in, we follow the next sell signal. So a very straightforward strategy. What we then do, I was just talking about signals. I use my own signal. It doesn't really matter what signal you use. This is just really looking at the chart. Here was the global liquidity cycle low that we experienced back in October of 2022. Not long after was my little signal there saying yet to buy in January 2023, and we've been up since then. You can see these markings on here. These are the Bob Lucas cycle work that he does. We're in the current 60-day cycle here. They're not really relevant to the discussion other than to give us a little bit of managing our psychology around it. So I keep talking about that. It's a psychological game. It's all about managing our psychology. What we're specifically doing here is going, well, yes, we're in a new 60-day cycle, but we're heading towards the end of that cycle here. So maybe that was the high of the cycle that we're going to see. Maybe we see a bit of a pullback. It's just giving us something to really look at and to analyze it at that finer time frame, but ultimately not changing our decision at all because we're nowhere near the end of the liquidity cycle. So it's if nothing else, keeping us entertained while we wait for that liquidity cycle to unfold. Historical performance, always important to keep a look at. We're doing very well. The current gain, 142%. That's as of this morning, 377 days in, which is 137.5% annualized. We're really just keeping an eye on that to make sure that our performance is up to scratch or is what we would expect over this cycle. And so far, Bitcoin has absolutely delivered as we would hope. This also comes into play, and we might discuss this shortly as well, about why we sit with Bitcoin. A lot of people argue, well, could you leverage this up even more with altcoins? There's many ways you could trade this liquidity cycle. I'm quite happy with 100 approaching 140% annualized return so far. I think that's risk adjusted about as good as you can get, because obviously as you go further down the risk curve, you with other trading other things, you're incorporating more drawdown or more risks that those projects don't survive. I'm very confident in Bitcoin. So we can talk a little bit about that a little bit later as well. So the additional data and analysis that I look at, which I'll just quickly go through before we bring in Joey, is US specific data. So it's not part of my general strategy, but it helps to guide my decision. And that's specifically the consumer price inflation data and the government debt linked to bond yields. So looking at the consumer price inflation data, and I know Joe will have a lot to say about this as well, we really use this truflation data because we find this a leading indicator in terms of what the government is reporting. So the government at the moment is reporting a rate of 3.4%. Now, when they were at much higher rates, we were already identifying that inflation was pulling off because of this data or getting much lower. So what we've seen here, 1.85% currently, really inflation is under control, which is a bold statement to make, but that's what the data is telling us. So even though we see this official rate a little bit higher, inflation, consumer price inflation is under control. Really important to understand the difference between consumer price inflation and asset price inflation. So what we'll now look at, if I now go to my next chart, which is US government debt. So this line here, looking at US government debt up and to the right, out of control, up and to the right, and the bond yields, which we talk about in a second, that debt is going to go somewhere in terms of one form of inflation or another. So my argument is that is going to go into asset price inflation, which is great for us with our Bitcoin trade or a gold trade, but not necessarily translate into consumer price inflation. So as we've seen, that's really down and relatively under control at the moment. What's concerning me about this chart, before we open up to more discussion on this, is I am quite concerned that we have these bond yields have pulled back a little bit, but I think they are probably going to head back up and probably head up quite soon with the pressure that's going to come if the Treasury in the US does what they say they're going to do and stop issuing short-term debt and start having to issue these longer-term bonds. Because what happens is bonds and yields are inversely related. So as these bond yields, what you're seeing here is the yields. As the bonds fall in price because people don't want to buy them necessarily. If they start issuing more of them, the yields will push up. And that could create a little bit of chaos and havoc in the markets, and something that we're not necessarily um, prepared for yet. That could be the black swan that throws a little bit of a spanner into the works with our whole discussion around liquidity. But we haven't seen that happen yet, but that is something that we need to be paying attention to. So we'll continue to pay attention to that in the months ahead. What I'll do now, though, is we'll head over and bring Joe into the discussion. First of all, how are you going today, Joe?
Good, mate. Thanks for having us all here.
Well, so
Love the presentation.
you've been through that presentation. You understand all of that. We talk about this quite a lot. What's your sort of takeaway from this month? Where do you think the important highlights lie?
I think the important highlights are not necessarily just for this month, but have been ongoing for quite a while. I mentioned to you before, who would have expected gold and Bitcoin to perform, or even Nasdaq and S&P, which were all a derivative of liquidity, to be reaching new all-time highs at rates at 5%. Like if you'd said that at the start of the rate raising cycle, you would have never imagined that asset prices were at where they are today. And I think that really reinforces the liquidity argument, where you're talking about not necessarily the cost of capital, but the ability to refinance the old debt into new debt. And that's really what drives asset prices. So, for example, even the chart with the heat map of liquidity from central banks, like that's a fantastic chart. You can really see, like, you can get all the data you want, but visually, like from my perspective, you can see how it's really transitioning. How we got all that green during COVID, we got that steep red during the inflation cycle, and now we're really starting to move in the opposite direction, which dovetails really nicely with the liquidity cycle chart that you've got there with the sine waves.
Which is that one? Yeah,
that one there.
Yep.
Yeah. And as you pointed out before, we're still moving, like we're sitting at 30 at the moment, say 50 being neutral. We're just tightening less. So
yeah, and that's a really good point, because people may not understand that about the liquidity cycle, that actually 50, this halfway line, is when we move into net liquidity injection overall. This is just saying that we're less restrictive at the moment.
Heading in the right direction. And people might ask, well, if we're still net restrictive, why is the Nasdaq, why is the S&P, why is Bitcoin all moving up? And we need to remember that those markets are very forward looking. Like if you look at the Russell, for example, they're still effectively in a bear market. That's the old economy. Value stocks, if you're looking at technology, Bitcoin, S&P, which is effectively the Magnificent Seven, they're all forward looking. So they're all front running this liquidity move. And this is where a lot of economists and market participants have got it wrong. They've been waiting for these rate cuts, and they've missed 50% of the move, depending on what asset class you're in.
So on that idea of rate cuts, right? Like, let's just spend a moment on this chart. Here, this red line is the Fed funds rate. So, that's the sort of official rate, if you like. There's expectation of those rate cuts coming. There's actually there has been expectation of quite a few rate cuts coming. I can argue that they need to come, because this debt financing at these rates becomes a massive burden on any government. But also, will they have the capacity to do it? How do you look at that?
I look at that as, at some point, it has to be the rate cuts have to come. Like if you're looking at, like you said, that $34 trillion at 5%, so you're financing 1.7 trillion a year just in debt repayments, which is now, last time I checked, outpacing military spending. At what point does it just become unsustainable? And I think there is the possibility that we may get some upside volatility, like you were mentioning before, when they start issuing bonds and coupons as opposed to the short dated bills they've been doing.
These sort of shooting up potentially.
Yeah, shooting up, so the bonds selling off and yields going up. Yep, like that's certainly possible, but I think that would be the last call for that, and be very obvious that that's the top for me in yields. But also,
so you think that might be more of a Well, see, I would argue that potentially if they get out of control, what we're going to see is yield curve control. And we're going to
Yes,
see
yes, 100%.
the
Yep.
government actually step in. Well, probably not the government, the Fed step in and actually not allow those to go up.
Well, they
Because
would cut the Fed. They'd cut the Fed. I think they'd cut the Fed funds, and then they would step in with the yield curve control, and that would be that would, I think, would be how the sequence of events would work.
right.
I don't know. I don't know if you agree with that.
No, I think that is where we get it. And that choppiness could be where we see like it's actually fascinating if you look how well, I mean, it's probably best to look at it on that sine wave again. How well
Yep.
this has responded. Like that's almost too perfect, right? How
Oh,
it's just, we,
it
we
was
can't
too
expect
easy.
it to just go
It was easy.
straight up. I
That's
mean,
right.
maybe it
And
does,
it's not
but
going to go. It's not going to go straight. Like I don't think it goes straight up. Like there'll be volatility along the way. Particularly when,
well,
like you said, we're
historically we've
talking
seen that.
about like we're talking about new bond issuance. Reverse repo. We got tax payments coming through March and whatnot. If you're just talking specifically about the US, I know it's not just the US, but it makes up a large portion of it, and we'll
Mm.
move to those other economies later. But you just really, for it to go like even during the COVID crisis, like it did go straight up, but that was very short lived as well. So I. I just nothing goes up a straight line, so I think we just have to be expect that there's going to be bumps along the way, even coming from these lows.
But do you think I'm starting to form the opinion that we do get right back up here again in this cycle? Um,
It's
it
like
feels like we
maybe I
will.
don't know. We might. I think even if it gets to 70 or 80, I think we make a lot of money, and we're going to be reasonably happy with that. Like that's sort of how I'm looking at it. That's probably harder to predict the top of the liquidity cycle from here than it is to sort of predict
Well, look at
pricing.
that.
Well, it's the same
Like
thing.
that's pretty exciting considering, like you said, we're just over 30.
Yep.
That the move that we've experienced, you wouldn't like probably by the time we get to 50, you would be expecting the price of Bitcoin to be back at all-time highs, quite possibly.
Exactly. That's right. And we've got room to run after that. Like I said, run to 70 or 80 on that index, then it's party time. Well, like the Nasdaq's already above all time highs.
Yes.
It's just Bitcoin will catch up. Gold will catch up. Gold's been a bit flat, but like I said, we're at 30 and the stocks are hitting all time highs, which is a pure derivative of liquidity. Then let's pick the fastest horse and just wait. That's all we got to do. Basically, just wait. As far as I'm concerned.
So before we open up to some questions, like what's your take on how we take maximum advantage of this cycle? So obviously we're in, we got in at a very good spot. People might still be getting in, but how do we take maximum advantage at the top? What are we looking for?
Well, I suppose the main thing we're going to be looking at is one liquidity cycle. Like not that we're going to be able to pick that perfectly. We've also mentioned those indicators that we use to initially get in at the start. Where was it? I think it was attached to Bob's chart. Yeah. So you've got your indicators there. Like ignore Bob's signals there, but we're basically ignoring the buy sells and the sell signals through the middle of the market, through the meet as it trends up. So we're really only looking to make that sell at the top. But eventually we get that sell, and it might not be the exact top, and and then also monitoring macro conditions. Like I don't know, it depends. It could be another inflation cycle that causes the Fed to get more aggressive again. You get stuff happening in the Red Sea with shipping rates and that sort of stuff starting to tick up. That could take 12 months to really play out, and then all of a sudden you might see the Fed starting to get really hawkish again after the election, which would potentially line up well with the liquidity cycle. Liquidity cycle we're expecting to stretch out to the 2025.
Yep.
By then we'll have the new president will be in, and inflation may be an issue, and like that's one scenario, and then they get hawkish again, and then everyone forgets after a couple of years and votes the same guy in. Like I don't know.
Maybe one last question before we open up to other questions. What do you think of this graph with the inflation rate? Do you think, because there's still a lot of speculation around there. You mentioned the Red Sea stuff that we're just going to see inflation take off again. There's a lot of parallels drawn with historical periods that say inflation's heading much higher, but then they tend to look at this 3.4 number, a slight tick up that they saw. I tend to really put a lot of weight on this data because it's I found it to be much more accurate. What's your take on the inflation angle?
I think so far it's been a great tool. It's actually been a leading indicator of what the Fed actually end up posting in their own
Yeah.
data. So if anyone wanted to sort of, it's obviously going to work better at extremes. Like when we're sort of a bit choppy, like we're probably about to go through a choppy period now, even though reported rate's 3.4 and that's saying 1.85. That's not really a lot of difference. Like it might seem like it's not really. So when we get to those extremes, I think this is probably one of the most useful tools, and that gave us that conviction as well that inflation, along with what Raul was saying, that inflation was coming down, because this was telling us that it was coming down before the Fed come out and told us it was going down.
Yep.
That's how I would use this chart. Yeah.
That's great. All right. Well, if we have any questions from our audience, so we want to try and make this as engaging as possible for people who are watching, but also to be involved each month. So if you just raise your hand in the process, and we'll answer some questions. And if you just turn on your camera and microphone, Jamie will help with that. So I might start with Isaac. Yeah, thanks, Isaac.
All right. So one of the questions I had was I noticed in the Bitcoin chart, if you could go to that one where you had the global liquidity cycle, you saw
this
that
one or the next one? This one?
Yeah, just that one there. So what I noticed was the bottoms were quite timed nicely, but I found that the tops were front run, but so the liquidity cycle peaks and then Bitcoin lags a bit longer. So the liquidity cycle goes up and Bitcoin. So it gives you a bit of time to decide when you want to exit. But I'm just kind of curious. I saw gold didn't have that large variance at the top. It was kind of in line quite nicely. So why potentially could that be happening? And even on the other cycle, you saw there was a spike too, and then Bitcoin obviously goes and hits its peak. So I'm just curious as to why the bottoms are quite nicely timed, but the tops is slightly delayed.
I think that's actually really easy to answer from just my own experience of what it's like at the bottom of a bear market. We already were comfortable that even without the liquidity cycle at that stage, that probably the bear had run its course because there was just absolute apathy in the market. So I think you tend to see that cycle low much easier to pick because it's retraced such a significant way. People have lost faith, all of that. The peak of a Bitcoin bull market is, as probably all of us on this call know, is a very different beast. You've got lots of wild speculation, lots of FOMO. And I think that's, particularly in this case, that's what we saw. We saw the liquidity cycle peaking out, and we should have been listening more than we were, but we were still in the middle, particularly over COVID. We still had all this money in the system and everyone just that blow off top that sort of came. It then pulled back and we had another shot at it where it just slightly went higher. That it's much easier to trick people out at the top than it is to trick people out at the bottom, I think. And that's what I think we just saw in this situation. So I think the Bitcoin cycle, from our perspective as trying to take advantage of the liquidity cycle, we probably should have been out when we were fairly confident that the cycle had peaked. It might not have been until probably back here, and absolutely would have missed the peak of the blow off top in what happened with Bitcoin. But I think that's the way to trade it, because we should have at least been cautious at that period of time. Comparing it back to gold,
I think that's where your signals would. That's where your
the signals help as well.
There.
Yeah,
it would have kept us in for those.
They would have, because there's a bit of lag. I don't know how strongly I would. It depends where we end up. If we end up on a really spiky top, if I was seeing something like that, like let's say we're back here, we haven't even peaked yet, and not ignoring the Bitcoin chart behind it, if we were seeing that really high liquidity, and you're going, well, how much further can it even run if we wanted it to? And you were seeing really spiky, speculative, blow off toppy type moves in Bitcoin, you'd be tempted just to take it there, right? Like I don't think you have to get too cute on the specifics. If we get a nice clean top, we certainly got a nice clean bottom, which made it really straightforward, I suppose. I just want to go back and look at that with gold, just to answer that question there. I think this is the difference between a fully established market where you've got gold really just reflecting effectively one-to-one. So it's hard when you, like even here, we say, yes, well, that was technically the cycle low, but look where we ended up on the cycle. We're very close, right? It was slightly lower there. So that's where I marked the low to be intellectually honest on it. But the price got back down again because the liquidity got back down again. And the gold is pretty much following it one-to-one. It just, each time, as you would expect, the base is higher. So it throws a chart off slightly, but that's the new base that we experienced. So that's the new low. But it's following the cycle very accurately in gold. Did that answer the question?
Yeah, that was really good. Yeah, that was very nicely done. I think I have one more, but I think I'll let Gavin go first, just so
Sure.
Yeah.
Gavin?
Hey, how's going?
Good. Is your camera on?
Yeah, nah, the camera's not good tonight.
Okay.
Thanks for the chat. Yeah, thanks for the chat. Very interesting. I just wanted to have a look at the gold liquidity chart. And
This one or the next one?
I want to get this one, that was great. I want to get the thoughts from you guys. Just looking at that's made me think, so the question you had before, like how do you play it at the top? The question everyone has, how do you play it at the top? And then with the ETF inflows, which will be a gradual thing over years, maybe this time's different where it doesn't crash all the way back down, where the Bitcoin
or
price,
gold?
where the Bitcoin price doesn't crash all the way back down. I think, looking at this for the gold chart, you could see something like this, and it's a good reminder that gold was like wanting to trying very hard to break out and continue all-time highs, but with that pressure of tightening liquidity, it really didn't get any steam to push through until liquidity started turning up. So
absolutely. And are you talking specifically about here?
Yeah, just the whole that whole long period, from I can't quite read the first peak 2020.
That's 2020.
Yeah, 2020, and then it hit again, and a retest, and then So I wonder, like my thoughts now are, we start taking some off the table at the high, or some months after the high, liquidity high, start taking some Bitcoin off the table. And even if, those ETF inflows were as positive as we like to hope, there's a good chance that just forget, like, tightening liquidity affects a lot of people, and it flows down a lot of different ways. So it's going to be very hard for Bitcoin to continue to keep trending up, and it could end up looking like this, I thought. What are your thoughts on that? And then, so, if you take some off the table, the lows, which have shown to be very good indicators when to get in because of that less hype, how you were just talking with Isaac about, even if you took some off the table and it trended sideways, or, it continued to grind a little bit higher, you like to think it's going to have a nice low in it again where we can jump back in.
Joe, do you want to talk about that?
I would just say that I personally find, even with the liquidity cycle and the signals, I find gold quite difficult to trade. Like if you're going to be in and out and trying to build a stack out of gold, I suppose that's where the volatility feature in Bitcoin really comes into its own, because it has historically been so retail driven and emotionally driven that we can use the liquidity cycle and the additional signal that the tip has created to help us actually stack more Bitcoin. I find gold very hard to trade, to be honest. I would personally use the gold as a buy. If you wanted a different type of insurance, I would be using the gold as a buy on the dips, and it would just be a long hold, potentially rotating into Bitcoin during Bitcoin liquidity lows. That's how I play it. Does that answer your question?
Do you think
that's
a chance that the coming Bitcoin top could look like what gold did in this chart that we're looking at? So rather than a massive drawdown, you could see a long,
my thought on
consolidation.
Yeah, and then that low, even though the price hasn't crashed, the liquidity low could then indicate, hey, we're ready to get back in on Bitcoin.
I just think that this cycle,
I don't think so.
Yeah, I think we've got probably 2 more cycles before, at least.
Yeah.
Before, to exactly Joe's point, the volatility is removed, where Bitcoin's just trading is gold, right?
Yeah, so we think the Bitcoin inflows aren't, and they're skeptical, like the boomer money is still skeptical. Like that's not going to take away the volatility for us in the next 12 months, is it? Next 2 years. It's going to take longer than that.
Yeah, I think
we've had a
that's
prime
why,
example.
yeah.
I think we've had a prime example over the last 2 weeks since the ETF has actually launched. So yes, we've got outflows from GBTC. The net inflows into the other ones are actually positive. So you've got more money going in than coming out of GBTC, yet we're still down 15%. And that really just goes to show how big the market still is outside of the ETFs. It can still, the market's still being pushed around by large players who are that don't have anything to do with ETFs. And I think a lot of people don't actually understand that, which is why they're having a little bit of a panic attack about why Bitcoin's going down after the ETF launch, if supposedly all this money is going to come in. And that just takes time. Like that's going to take quite a while for that money to really
on that point, Joe,
build up.
Gone down, right? Like, because I find that quite fascinating. Yeah. People can't zoom out. Look at this chart here. That price, that blue line, is the average price over the month.
Yeah.
Does that look like it go down to you? Like, because it got up to here, got up a bit higher, and then dipped back. If you look at the average, that's a very clear one directional line. So this idea that people have the price didn't take off. We go, well, if you understand the tool, like if you understand the global liquidity, I'd say that took off exactly as it was supposed to, regardless of
it's been taking off. It's been taking off for 18 months.
Yeah.
Well, not 18, but 14, 15 months. But yeah, exactly right. And, absolutely 100% due a pullback at some stage. There's going to be profit taking at these levels, particularly when, a large amount of money flew into GBTC. One, because it was cheap. It was the only way to get into Bitcoin from institutions. And two, it was trading at a discount. So you've had 100% or 130% gain since the bottom, plus whatever the 30 or 40% discount was that they made when they bought at the lows. So, not everyone trades like us, where we try, like some people actually have fiduciary duties and responsibilities where they have to take the profit, or they can't just let the Bitcoin run wild for year after year, So like
not everyone trades like us. That'll be the quote for the call.
Yeah. Die hard.
Did we have any other questions?
You know what I mean.
Isaac, you had another question?
All right, can you guys see me?
Yep.
My video's gone now. Yeah, cool. So another one I had was, when you reach those euphoric stages, specifically what sort of macro metrics and conditions are you looking at to sort of gauge that exit? Because I know during euphoria it's really hard and I know timing it's tricky to time it, but you want to obviously maximize your potential.
Yes.
But specifically, what would you use? Because I know the liquidity cycles we've seen in Bitcoin, it went out, it went up before, and then crypto goes, like Bitcoin went up after that. So
is what we see right here, right? Yep. That takeoff. Yep.
With that in mind, because you want to obviously maximize your profits. So if you theoretically took your profits at the peak of the liquidity cycle, you would have been sitting at around, is it like $20,000, around that mark, I would say.
Which was still, yes, to your point, was still more than definitely, like triple your money or something. But yes, I get your point. Wasn't what it could have been.
Really good returns, but you're kind of missing out on the mania stage, and that's like when you're putting your money in crypto, which is like a risk on asset. That is something you want to do, and you want to capture that real big euphoric stage. I know that it's really hard to time it, but what sort of metrics are you looking at to maximize that profit you can take?
That's an excellent question. So I think what we need to understand about this cycle in particular was COVID money. So had we not had the massive amount of injection, like stimulus injection that everyone got directly, I would argue we probably wouldn't have seen this as unaligned as it was to the peak in the liquidity cycle. Because remember, this is 2020, right? So we've got that coming in really later in the year, that's really reflecting that. So, and particularly that second spike, that's 100% reflecting all that extra money that people have in the system, because it takes a while for them to get the money, to not be concerned the world was going to end. Yeah, there was a lot going on to get us there. But to your point, I think that's where we have to be conscious of pretty much everything that's in the presentation, right back from this chart. So I think we need to be looking at what is going on in the big picture as well, because when we talk about this idea of private sector liquidity or collateral, particularly collateral, it actually ties to the last chart, which was I'll get to it, which was the bonds, right? So we have a couple. The reason I keep bringing these charts in all the time is because there are other indicators here that are going to tell us what's happening in the economy generally, whether that is inflation. But I think this time it's going to be bonds. I think we're going to see this market reacting to what's coming next, probably in tangent with what we see in the liquidity cycle. So I think that's going to give us some indication of what to expect. Particularly, that's why I was mentioning it before. I think we're in for a bit of trouble later this year when these yields start going up and out of control. What I don't know is what yield curve control actually means for the cycle, because what could happen is yield curve control could actually lead us to exactly what you just described. It could lead us to a situation where the liquidity cycle may have peaked, but we end up with another mania phase, because it's very much like the COVID experience was, where everyone just gets crazy. So I don't know the answer to that. I think we have to be looking at everything all the time. And to be honest, that's why we're having these monthly updates, because we need to keep our eye on the ball and not just rely on one theory, even though so far that theory is playing out very well. We need to have the other bits around it as well, and discussions like the ones we're having now. Joe, you got anything to add on that?
No, I agree with that. Like, sort of back to what you said initially, the bottoms are very easy to pick. The top, whilst we like to think we can always pick the top or get somewhere near the top, it's very much a work in process all the time. It's going to be difficult, but like you said, we try and stay focused on like you said, the big picture, macro, our indicators that we've got, and draw conclusions from that to try and figure out where we can take the most profit from.
And one other thing, we did mention it before. This is blown out of proportion, because we're looking at, actually maybe the previous chart's easier to see it on. Well, that's logarithmic, but you do have to remember that at the cycle low to even the cycle high there, when you're looking on a logarithmic chart, that was a lot of money, like a large percentage gain. So you do have to factor in that, would we have been happy with 300 or 400% return over that period of time? Or are we just going to ultimately be kicking ourselves because we didn't get the next 300 or 400%? So I don't know. I don't know the answer to that, how we'll handle that psychologically if it happens again. But I do feel, and we mentioned it before, I do feel that this chart may play out more to the letter than it has previously, simply because of the debt situation. So if that happens, then if the perfect situation is that we may actually get a perfect top that corresponds with, you get that feeling, when we're at a speculative Bitcoin top, because it's just everything's just blowing up. So we may get that at the same time, and we might be more than happy to take at least the majority of the profit at that point. And then if we want to leave a little bit in there to speculate for the bubble top, then so be it.
Yeah. And remembering that the volatility that got us to those highs will be the same volatility that brings us down to the lows as well. So, if you're somewhere in the vicinity of the top within maybe 15, 20%, and the volatility still exists to the downside, then you're always going to be able to stack more, generally speaking, if you believe that we're still getting more volatility, which I 100% expect that we will get going forward, even with all the ETFs, even with the institutional flows. It's still very retail driven, so the volatility is going to be there.
And
that's the goal. The goal is to stack more Bitcoin, in my opinion.
Yeah. And I do believe, and you would as well, that the actual profit is made in the bear market, because that's where we're going to get, we know we're going to get another good entry in the future. So the profit's made by having as much capital as possible to load up on that next cycle.
Yeah, that's right.
And that really answered the question. I guess it also depends on your risk tolerance. If you obviously went up at 3x, even when it did peak to where it went, and you could take out majority of your portfolio then and just let the rest run to the euphoric stage if you the portfolio of the person. So, but yeah, thanks for answering that, guys. Appreciate it.
All right. Are there any other questions? All right. If there are no other questions, I might call it there. Thanks everyone for watching our update for the month, and thanks to Joey and our audience with their questions today. Really appreciate that. It makes it much more engaging, and hopefully we get more people each month that find it valuable to participate in this way, and we can have that discussion, because I think the more of a discussion it is versus just presenting, the more we all understand. And we absolutely want to be here together when that top comes, because as we just witnessed and discussed, there's going to be a lot we need to think about when that high is in place. So that's
just on that as well. I think one last point, that's going to be very valuable around the top as well, having more than that one voice opinion. Everyone's going to be euphoric. Everyone's going to want to hold it and run right to the top, but that's the reality is that never happens. So you need someone in your ear.
It might take a village to exit at peak FOMO. So we might need everyone on the same page for sure. As I mentioned at the start, always welcome feedback and discussion. So follow me on X at Tipper Analytics to stay up to date or reach out. And we'll be back in February with the next monthly update to reassess where we are, what's changed. If I'll talk to you again then, if not sooner, on X, Discord, or the Real Vision platform. So until we get chat again, then good luck in the market, everyone.
Thanks, guys.